Finding a consumer staples company offering a dividend yield north of 6% is exceedingly rare in today's market. The company offering this payout is General Mills, the food empire behind some of the most recognizable items in your pantry. They have maintained shareholder distributions without a single interruption for 127 years. They successfully paid dividends through world wars, crippling recessions, and major market crashes. Based on recent data, that 6.2% yield translates to approximately $2.44 per share in annual cash income. If you hold 1,000 shares, that is roughly $2,440 a year. On the surface, this combination of high yield and century-long reliability appears to be a premier safe haven investment, but the financial reality suggests otherwise. In recent fiscal results, General Mills generated $18.4 billion in sales. Yet year-over-year revenue actually shrank by 5%. The bottom line suffered even more severely. Reported GAAP operating profit collapsed by 73%. Yield must be evaluated relative to stock price. As the share price falls on one side, the dividends yield automatically rises on the other. When the market pushes the yield past 6%, investors are actively demanding a premium for taking on measurable business risk. A yield this high serves as a clear warning sign from the market that the underlying business is deteriorating. However, that 73% drop requires some accounting context. The reported GAAP number includes heavy, one-time impairment charges that obscure how the actual business performed. This bar chart clarifies the damage. Once management strips away those unusual accounting items to calculate adjusted operating profit, the true core decline rests at 16%. While a 16% drop is far better than 73%, it points to a distinctly injured business. The primary cause of this fracture is severe household budget pressure. Food prices remain high, and financially squeezed shoppers are increasingly choosing cheaper, private label store brands. This puts General Mills in a pricing trap. Raising prices loses customers, but lowering them destroys profit margins. Because they cannot force budget-conscious shoppers to pay a premium for brand recognition, the company has effectively lost its ability to reliably grow organic revenue. With top-line growth stalled out, management is left with only one viable operational lever to pull: internal efficiency. To combat the slump, the company launched an aggressive cost savings program, targeting $3 billion in cumulative reductions through fiscal 2030. There is an immediate urgency to this timeline. Management expects to execute at least $750 million of those savings by fiscal 2027. This line graph illustrates the strategy. Even if the top revenue line is falling, aggressive manufacturing improvements and reduced overhead can force the total cost line to drop at a similar pace, artificially preserving the profit margin gap in between. This $3 billion initiative is a desperate race against time. The entire strategy is designed to protect the cash flow necessary to keep their historic dividend alive. But corporate cost-cutting has an absolute limit. It is a temporary survival tactic that cannot permanently replace organic consumer demand. Smart income investors know they must look past the immediate gratification of a 61-cent quarterly payout and instead scrutinize the underlying health of the operation. That means tracking three specific top-line metrics to gauge consumer demand: total sales volume, organic sales growth, and overall market share retention. On the bottom line, it requires monitoring adjusted operating profit, total free cash flow, and whether management is actually hitting the milestones of their $3 billion savings plan. Future dividend safety depends entirely on these 7 metrics, proving the company can generate enough cash to fund tomorrow's payment. So, does this 6.2% yield make General Mills a strict buy for an income portfolio? It is far from a simple buy and hold asset. Buying this stock today means entering an active, high-stakes test of whether a legacy empire can successfully re-engineer its operations to win back a modern, price-sensitive consumer. This 6.2% yield represents the premium investors demand from the risk of a high-stakes corporate turnaround.